Hi, my name is John Repp, and this is my wife, Cindy Cole, and we're here tonight to talk to you about the Washington Investment Trust. It's been called the last 4 years the State Bank. I think the proper name now, as you'll hear, is the Public Infrastructure Bank, but the bill will call it the Washington Investment Trust. Actually, Cindy and I learned about the idea in December of 2008 by reading Yes Magazine. Anyway, there was an article there about public banking, its history in the colonies and during the Civil War, and more recently with North Dakota. Anyway, so then I met with Bob Hasegawa in December of 2009, and he had heard about the bank as well, and he wanted to put in a bill, but he didn't have one, and so he asked me to write one. Well, I've never written a bill. I didn't quite know what to do. Actually, I was panicked. I even Googled how to write a bill and got some answers. Then I asked Cindy to help me, and we decided to email the Bank of North Dakota and ask them to send us the legislation that established their bank in 1919, and they did. So that's what we used as a template for that first bill. And our idea, and we wrote this in the legislation, was to, this would be a way to finance a transformation of our farming system and our energy system so that it would be more sustainable and resilient. That was the original idea.
So the bank, as you've heard, that we modeled that first bill after was the Bank of North Dakota. And it's the only state in the Union that has a public bank. And it was founded in 1919. After World War I, there was a real depressed economy. And the Nonpartisan League came into power in North Dakota at that particular time. And at an election in 1918, I believe, they swept in the power. They took the governorship, the legislature, and were able to get enough people on the state Supreme Court also. And I'm going to show, we're going to show a small clip from the Bank of North Dakota because it really explains, I think, in a very good way, even though the Washington Investment Trust now is different from it, the difference between a public bank and a private bank.
The Bank of North Dakota is different from private bank in a very simple way. A private bank takes your deposits and it pays you an interest on your deposit, and then it takes your money and lends your money to someone else and charges someone else more money than it's paying you, and it makes a difference in the spread. A state-owned bank has a different mission. Its mission is not to make a profit. Its mission is to serve the people of the state. It's able to take a really long-term view about what's the right thing to do for the people of the state at this moment in time. Right now, it's a $4 billion bank. It's capitalized with the state's earnings. It is paying interest on that money to the state treasurer, and it's using that money to create different lending opportunities for North Dakota family farms, for farmers who want to diversify, for students who want to go to college. When the Bank of North Dakota was being set up, it had been a state for 30 years. 95% of the people were engaged in farming. It was being, in the grossest terms, ripped off by the interests out of Minneapolis and St. Paul and Wall Street interest. And it was practically impossible to make a living at anything. If you would go to borrow $100 from the bank, you would come back with $68 because they charge you 12% interest and a $20 origination fee. And the farmers were really mad. The opponents of a state-owned bank did everything they could possibly do to stop it from being established. They took 2 challenges to the United States Supreme Court, and the United States Supreme Court said, if the citizens of the state want to do this, they should be able to do it. And And then there was a drought in the 1920s. And these farmers just had to see that dream turn sour when they couldn't pay not only the principal, but the interest on the loan that they had with the bank. And people would write notes to the bank on a torn sheet of paper. I would send it to you, but I don't have any. We don't have a crop. I haven't had a crop this year. I didn't have a crop last year. They didn't have money to even feed themselves, much less to pay a bank loan. The bank tried to collect the money. The Bank of North Dakota representative would just say, I can't take money from these people. They don't have any. And it became very clear in the early 30s, and this is when Bill Langer was governor, and Bill Langer created a moratorium on debt. So the bank stopped doing any kind of foreclosure and then allowed them to stay on the farms. When the economy turned around in the early 1940s, the bank sold those farms back to the original farmer at the price the bank had in them. The Bank of North Dakota is doing amazingly well, given the worldwide economic crisis that we're in. It's as strong as it's ever been. The fact that it isn't suffering any of the fallout from the financial crisis that the other banks are, I think attests to really the strength of the bank and actually the bank's mission. And they didn't invest in risky derivatives. They didn't buy any subprime home loans. It didn't fit the way that they did business. During the last 90 years, the bank has returned $500 million to the state's general fund. What that means is the state has been able to develop programs, $500 million worth of programs, without taxing the people of the state to do those programs. It really, in my mind, it doesn't matter if it's socialism or capitalism. You know, what matters is what works best for the people, what provides the most services at the least cost.
The people of North Dakota love their bank. It's really helped the state. There have been no bank failures in North Dakota. Here in Washington State, we've had, I think the last count was 15 bank failures. And you know, those have been eaten up by larger banks. Umpqua Bank from Oregon has come in and take over several banks. So anyway, this just shows from February 09 through February 010, the percentage change in economic activity. And as you know, that was when the big crash happened. And here's North Dakota up here. And they were the only state that continued to prosper during that particular downturn. Washington's here. Washington's there. John and I have heard, of course, quite a number of arguments over the years, and one of those is as well, there's only one, you know, public bank in the whole of the United States. That must mean it's a, you know, some kind of deal that just doesn't work very well. But we really think it's really, that reason is because there's been a real hostility over, really since our nation was first founded, a hostility toward government involvement in banking. There was actually a huge fight between Hamilton and Jefferson, and when they were establishing the first national bank of the United States. And then also the other argument that we've heard is, well, the reason that North Dakota is doing so well is because they have oil. And that is true. Right now there's an oil boom in North Dakota. But the Center for State Innovation, which is a nonpartisan actually study group, did an investigation of the differences between Montana, North Dakota, South Dakota, and Wyoming. All four of those states are agrarian, they have small populations, and they all have oil, natural gas, and coal, actually. And in that particular study, what they saw, again, which this diagram actually demonstrates, is that North Dakota, taking all things kind of equal, still had an economy which did not go into the red, and a state government that did not go into the red during the crash. Now, as I've kind of mentioned, the Washington Investment Trust, which is the bill that has been introduced into our state, Washington State Legislature, is different than the North Dakota Bank. And John will explain a little bit more why that's so as we go along. But it will be able to loan to governmental entities like school districts, water districts, cities, towns, counties, for infrastructure projects. And that's kind of how we're starting out. And we'll go into that more as we continue. To understand our state a little bit more is how we handle our money now. And you know, you don't think about it very much. I never really thought about, okay, when all our taxes and fees are collected, where do they go? They don't go to a big vault down in Olympia. And where they go is into a consolidation account at Bank of America. And if you've just heard the latest news about Bank of America, the United States government is suing them for brazen fraud, finally. So anyway, what the Treasurer then does, the Office of the State Treasurer does, is they have a contract with Bank of America to do this, to collect all the taxes and fees. And then the Office of the State Treasurer then from that consolidation account will pay the state's bills. And anything that does not need to be used immediately, any funds that come in, because you know it fluctuates, how taxes come in, et cetera, they are invested by the Office of the State Treasurer, but they're invested in short-term, usually U.S. Treasury bonds, and because those are very liquid, and he can get them out quite quickly. There are also some other longer-term investments, but it's all done in paper. All of the investments are done in paper. And the Washington Investment Trust, then, if we have a bank that will loan to counties and cities, it will be loaning to infrastructure projects, right? It will stay local here in Washington State and also benefit the people, and it's real. There will be real projects come out of it, not just paper.
So the reason we're starting this is because there's a big debate in the state that the state's credit cannot be loaned to private businesses. So that's a constitutional question. It's debatable, but it's because you need 2/3 in the legislature and a public vote. We're not going to go that way. We're going to start with a bank that will loan money to other government jurisdictions. And that can include state agencies as well as cities, counties, water districts, sewer districts. Again, the deposit base will be the taxes and fees, and the loan portfolio will be short-term construction loans for these jurisdictions to build their projects. There is actually a huge backlog of infrastructure projects that we need to start funding in the next few years. Now, currently, a local government or state agency, if they want to build an infrastructure project, they have to go to the private bond market, and they have to pay large upfront fees. And then, of course, the bank that floats the bond to them will collect the interest over the life of the loan. So the Washington Investment Trust would finance those projects without the large upfront fees and at a lower interest rate, and yet would still make money for the state. So that's the idea. And as you can see, it will circulate the money in our state. The circulation flow now is out to the federal government and the Wall Street banks and as we know, it's circulating everywhere in the world but here.
This just gives you a little idea of the bill that we're looking at right now. It's still in draft. It's still in process. There's a committee working on it. We hope to have it done by probably the end of this month or so. But basically, these items will be in the bill. And the mission, again, would be to benefit the people, benefit the citizens of Washington State, and to circulate tax dollars here locally within the state for economic development and for jobs. And that would be its mission. It would not be to make money for private stockholders. And in it, there will be approximately five. There's a little debate whether we should have 5 or 3 or 7, but probably it will come out 5 statewide elected officials on the board. And this is so that there's accountability to the voters. They're elected positions. Most likely it would be the governor, the treasurer, the attorney general perhaps, secretary of state, those types of folks. There's also a citizens advisory board. I think this is a citizen advisory board of between 9 and 15 people, and that's from all different areas of citizens. But bankers will run the day-to-day process, right? The day-to-day happenings within the bank. We don't want this bank to be something that politicians can go to fund their pet projects. We don't want this bank to be something that the economic development folks, although they might have a good plan, can just come and get something. It's not a lender of last resort. We want, loans that give us a return so that we can build the bank. So we're starting out with bankers running the bank, and these bankers will be public employees. They will not, state employees. They won't, you won't have a president that gets huge bonuses. We've been trying to keep into the legislation that the person, like the president, would not make any more money than 10 times more than the lowest paid person. I don't know if that's going to stay in, but that was something that John and I really wanted in the bill. We'll see if it stays in there. So that is basically what the mission is. The other, actually John will bring this up, but we want the loans to be the type of loans that the private banking system would like, because then they know that they will get a payoff. Public entities usually pay off their loans.
So the question of liquidity, and this has been an argument that our state treasurer has made. And our answer basically is that this will function like a bank, and what a bank has a privilege of doing is when they loan money out, they add money to their asset column. That's because the money will come back with interest, so it becomes part of their capital. Unlike you and I, if we want to loan money, our bank account goes down. So banks have a different accounting system than most families, and this will basically allow them to have liquidity while they are also loaning out the money. Basically, there's a relationship between the deposit side and the loan portfolio side of a bank. It's mathematical, it's not physical. In other words, there's not money being transferred back and forth. So this quote is from Robert B. Anderson, who was known for his candor. He was the Secretary of Treasury under Eisenhower, and he basically let the cat out of the bag and said that when a loan is made, it's not taken from someone's deposit, it's actually new money loaned out, and it in effect is creating money. So this shows how the system works as a whole. So there's cash, we'll say cash going in the first bank as a deposit. And then the next day, if there's a 10% reserve, they can loan out $90. Now that $90 If it's loaned out to someone who has an account in that bank, it'll stay in that bank, but it could go into another bank. In any case, when it becomes a deposit, then it's added. So the way this works is with $10, theoretically, can become $1,000 as it's fanned all the way through the economy. It never does that because not all money's in the bank. It's in transfer between people and businesses. But that's what can happen in the banking system. So basically new loans can become deposits. It's kind of like, I don't know, it depends on your financial situation, but most people, their total net worth is not dollar bills in their mattress. It's in the bank, and it's not all cash. So the government prints the cash, but the money is created by the banking system. So again, this bank will be loaning to government entities to build roads, bridges, schools. But this is, what I'm trying to say is that our private banking system creates our money. Okay, money is created by debt. And there's a positive thing about this. It allows our economy to expand. But there's a negative thing about it, and that is that, particularly now, the big Wall Street banks, and there's, I think, 5 or 6 banks, control more than half the deposits in the whole country. They are and hedge funds in Wall Street are loaning money to each other. So you can see with this, and then on top of that, they're speculating with it. Their own trading desks are speculating on the world market. In the last 30 years, there's been hundreds of opportunities because capital can flow around at the click of a mouse, hundreds of opportunities for investments all over the world. And that's what they're doing. They're more interested in that than they are loaning money here, or that's their moneymaker now, and that's pulling money out of our economy. And that's one of the problems we have. And so that's what the state bank or the public infrastructure bank is designed to do, is to take that amount of money in our state, 5-6%, and circulate it in this state. Now this system, in essence, this system has been around for at least 400 years, the private fractional reserve system. And if you know history, there's crashes about every generation, sometimes more often. There were 4 big ones in the 19th century in the United States. And of course the big one in 1908 and then 1929. And of course they had crashes all over Europe in their 400 years. So this system would allow the money to grow fast. Also, it can contract as fast. And that's what a credit crunch is. And that's kind of where we are. So it's the architecture of the system now. Some people would like to change the architecture, but we know from history that very, very strong regulations, which were put in place after the last depression, allowed the system to function without as much trouble. Basically, they separated speculation from ordinary banking. So we're not trying to get rid of the basic system. We're just trying to take some of the money and get it circulating in this state. And we think the private banks have abused the privilege that they've been given by the states and the federal government, and that it's time to try another model, the public bank. So 2 other concerns are the safety and return. So will this idea return more money to the state or less money? Well, right now interest rates on short-term construction loans are higher than interest rates on T-bills or CDs, so the return would be higher. The WIT would earn more money for the state. Also, the local jurisdictions or state agencies that would be borrowing money from the Washington Investment Trust could borrow it at a lower interest than they would on the private market. And so they would save, and the large upfront fees, which are significant, would be a savings to them. And we think the return, as part of the return, we have to count the jobs that would be created by the infrastructure projects, the new schools and bridges. As far as safety, again, Cindy said it would be run by bankers, and they would be subject to annual examinations by the Department of Financial Institutions and the state auditor, the same system that would control that does control the private banks. Another aspect of safety is that at least in the last 30 years, there have been no losses on state infrastructure loan programs in the United States.
So it is a valid question about how we're going to capitalize the bank. And at last year's task force, a graph was given to the task force. And what it showed is on the top, there's like a liquidity portfolio that the treasurer uses. And that you can see it goes, like this over the year, where funds come in, they're spent right away. Then there is a core investment portfolio, and it's in a larger band underneath. And what that shows, or what that particular core portfolio is that those are longer term investments. They're not the short government security investments. They're longer, and usually they're 3, 4, 5 year investments that the Office of the State Treasurer has been able to do and hold, right? He hasn't had to liquidate those. Sometimes it does, but over the last, is it 10 years? Over the last 10 years, that has not gone below $2.1 billion, that particular core portfolio. So what the Washington Investment Trust Task Force is looking at is to look at that particular core portfolio, and if we could just have a small portion of that, even like 100 million or something, then that could be leveraged, like John was saying, holding back a certain amount because of the power of having a bank could be leveraged, into loans. 100 million times 9 or whatever. That's how much you could loan into the economy with an infrastructure. There's also a small one that is money markets and CDs that, again, very, very liquid, that could be, that the treasurer uses on that particular diagram. Another possible way to capitalize the Washington Investment Trust, and we're looking into this, is the what is it called? Yeah, the local government investment pool. And this is an investment portfolio that has about $8 billion in it. And municipalities, cities, counties, small towns, they often don't want to invest their own cash, especially if they're smaller. They give it to the Office of the State Treasurer to invest for them. And that is what is in this local government investment pool. That is invested also in quite short-term investments, but what we're kind of asking, and I've actually put out the question to the city of Seattle and King County, because I have a couple of contacts there. The county, King County, does invest in the local investment pool, government pool, but only if it's getting a better return than what they can do on their own. So that gives a possibility to say to King County, hey, why don't you do some of your investment in the Washington Investment Trust? Give us some capital. Yeah. Seattle's in Wells Fargo, I think. Yeah, right. Yeah, Seattle's in Wells Fargo. Yeah, if they could have a place to put their money. So anyway, that's also being explored. A final way which would possibly be able to capitalize the bank would be to sell bonds. Now that means that you are going out on the market to do that, but we feel that we might be able to do that. Maybe you guys have noticed in your on your ballot there's a initiative, or there's a recommendation from the legislature that we lower the debt ceiling. If the Washington Investment Trust could float their own bonds, because we would have a revenue stream from the interest from the loans, and therefore the Washington Investment Trust would pay back the bonds, rather than having the state have to keep it under its debt limit as general obligation bonds are right now. And then that comes out of tax money. We can't probably use those, but if we had our own revenue stream, we could do it. So that's again another possibility, just something that we're looking at and trying to do. It would be much better if we could actually get something like an investment, because then we could grow the bank faster than if we had to pay off bonds, of course. The public banking movement is nationwide, and this is just to let you know where it's all happening. The Public Banking Institute, John and I are the state coordinators for the Public Banking Institute, which is a national nonprofit organization. They're all volunteers, just like John and I are volunteer, that are trying to introduce this in various states. And the blue are actually states that have initiated or put legislation to establish a public bank. And the red are study bills that have been introduced. The green, as you can see, there's North Dakota. And this one's actually really kind of interesting. In Oklahoma, an Indian nation has their own bank. So essentially it's their public bank for their Indian nation, and that's in Oklahoma. And then Colorado has an initiative on the ballot. They've gone and gotten signatures, and they're putting it directly to the people. They couldn't get any legislators interested, so they're trying that. So that is what's happening on the national scene. Just want to talk a little bit about the history. And public banking is not new to the United States. We've already mentioned North Dakota, but the colonies had their own banks. The governments of the colonies had their own banks. Massachusetts, Virginia, Pennsylvania, North Dakota, North Carolina. And the best one of these was, actually the one that worked the best was the Quaker colony of Pennsylvania. And they were able to, because they were able to loan money in, and they did it very prudently, into the economy, and then also spend money into the economy. The government just spent money, but they did it very well and didn't cause inflation. The interest that the loans that they put out into the economy, that interest paid for the government. They didn't have to tax the people for about 25 years. They did have a tax on liquor, but it actually worked the best. And in fact, Benjamin Franklin went to England to talk and kind of plead with King George that, let the colonies have this. This is really, helping our prosperity. And King George said, you're not supposed to be prosperous. You're supposed to be, a colony. And you have to buy all your goods from us, and you have to pay all your taxes in gold. And of course, the colonists didn't have gold. It helped start the revolution when they would no longer allow a colonial script, as it was called. And then also just recently, in the past couple years, the state of Massachusetts was trying to have establish a bank, and the Federal Reserve of Boston wrote a paper critical of it. And what you have to remember is the Federal Reserve is not really federal. It is a consortium of private banks, and the governors are appointed by the federal government, but the owners are actually private banks. And so the Federal Reserve of Boston wrote this critical letter, and John and I are, madly reading it when we got it over the internet. And one of the things that they said in it, as we're reading, was that banking should remain in private hands unless there is a market failure. And both John and I kind of went, well, didn't we just have a market failure, right? And obviously, to the big banks, wasn't a market failure. They came out, as you know, quite well, whereas so many of our citizens lost their jobs, lost their homes, etc. And so again, we're kind of emphasizing this, but the larger context is to take some of our public money away from those big Wall Street banks and keep it locally here in Washington State.
So we found this interesting. We actually got these slides from Representative Hasegawa, but 2 years ago he went back to North Dakota to talk to the bank there, and while he was there, he went to their historical museum and he found this newspaper clipping from just before 1919, and this is when the Nonpartisan League was agitating amongst the citizens of North Dakota for a public bank and a public grain elevator, and they also eventually built a public railroad because the banks, the grain elevators, and the railroads were the three entities that were ripping these farmers off. And so they pointed to Seattle and said, look, public grain elevators work. A public port in Seattle has a grain elevator, and this is what we want to do. So they got their inspiration from us. Anyway, you can recognize our elevator. It still says, or no, Port of Seattle on the public elevator. I think the sign's still there, the structure's still there, and that was partly their inspiration, and now we want to be inspired by them.
But we just want to also say that we do realize that the Washington Investment Trust is not the silver bullet. It's not going to take us out of the present recession, but it is beginning something, and we hope that it brings a brighter future for our children and our grandchildren.
Our purpose here tonight, and I think this fits in with your Common Good Cafe, is that we want citizens to educate themselves about this. Now, banking is kind of an esoteric thing, and quite frankly, I don't know what goes on in the insides of banks, and I don't think they want us to know anyway. But we want people to become confident in these matters, and so they can talk to their friends and their legislators. Because we've noticed over the last 3 sessions, a lot of legislators weren't listening to their constituents. They would talk to economists or bankers to get their information about how banks should be run and how what do we need. So again, they weren't listening to their constituents, and that's sad. And I bring up the lesson of history that the idea of federal deposit insurance was rejected by bankers, economists, and FDR himself when it was first floated. It just didn't seem like something that the federal government would do. But the people demanded it, and Congress passed the law, the Banking Act of June 1933. That's the same law that's also called Glass-Steagall that separated investment banks from commercial banks. So sometimes the people know and are ahead of the economists and the private bankers. Of course, we know the private bankers have a dog in the fight, and the economists, they do too, but believe it or not, I don't think they all understand banks unless they take special courses. But anyway, so we want people to educate themselves and feel as comfortable as possible about this so they can talk about it. And the main thing is that this is going to be a public bank, and we're going to put our public money in the public bank for public good, and it will create thousands of jobs across our state. Oh yeah, any questions? Yeah, Richard. Well, we expect in a couple of weeks to have the bill. Bob promised that. Hopefully that's the case. It'll be introduced in January, and then there'll be some committee hearings. I think it's going to go through the capital budgets committee in the House, and that's Hans Dunshee, and he's agreed to sponsor it in the House. And then, as I said, Bob Hasegawa, he got almost 70% in the primary, so he will probably be elected senator. He'll introduce it in the Senate. The last several years, there were hearings, and we were able to get a lot of people down there. We just passed the word, and they wanted to go, so the rooms were full of supporters. There were only two people that spoke against it. One was the state treasurer, and he has a lot of clout. And they didn't do a public vote because they knew it wasn't going to pass, and they didn't want to embarrass the ones who were going to say no, because they were Democrats who were going to say no. The Republicans so far have not touched this. Bob says that several of them are interested and kind of like the idea. By the way, North Dakota is a Republican state, and they love their bank. So it shouldn't be a partisan issue. But in this state, the Republicans have said no. So it's Democrats, and it's those, they call themselves a roadkill caucus, the centrists. The centrists have held it up. But so it was last year, Representative Hasegawa got 44 co-sponsors, and that was the highest single number of co-sponsors for any of the legislation that was in the House. So I don't know if that answered your question, but probably in February there'll be a couple of hearings, one in the House and one in the Senate, and then they'll take a vote, and if it will go into the full House and full Senate. The Speaker, yeah, the Speaker of the House, Frank Chop, is supportive of this. Well, that's the hurdle. Right, it hasn't so far. We don't know. Well, we're hoping public pressure, and the composition of the committees will be a bit different because of the elections. So you're right. It's not a slam dunk, even though what I learned, hopefully this won't sound cynical, but the legislators are not listening to good arguments or good ideas. They're listening to power. So that's why we need to try to educate as many citizens as possible and get them active and have them talk to the legislators, particularly from their home districts, whichever legislators are standing in the way of it. I think most of the Seattle legislators are pretty good.
Yeah, Jamie's tough. However, we're going to try and not have it go through the committee that he's on. We want to put it through the Capital Budget Committee, which is headed by Hans Dunshee. We have a much better chance of getting it through that. It's probably going to be harder in the House, in the Senate. But we will have, Bob Hasegawa can be there to try to usher it through. But if we can get it through the House, that would be, one more step in this drive. Are there any other questions? Yeah. We have a distribution list that I keep that has about 300 people on it. There's 2 sign-up sheets there in the back. If you want to be on that email list, you can. And as things come up, we'll be sending, information out. We also have some cheat sheets for you guys, question and answers, that I can pass to you so that you've got some background, because this is kind of a quick thing. We, especially when it was first introduced, I know that Bob Hasegawa spoke with several bankers. John and I met with a banker who didn't want to touch it with a 10-foot pole. He was a small banker. Usually what the small bankers do is that they go along with the big banks, even though you can make a real strong argument that the big banks actually aren't on the same page as they are, and actually are in great competition with them. Now, the first couple of years that the legislation was introduced, the banking, what is it called? It's an association of bankers did speak against it. But this last year, only the treasurer did. And one other fellow, which I don't know where he was from. But the treasurer actually holds a lot of clout, and we also think he was speaking for the banks. The banks could remain silent, right? They didn't have to, be against it. But I think that's, they'll do they'll do their lobbying, in the background, and that's what we have to fight against until it comes out to a big fight, and then, then you might see them more. I don't know exactly how to counteract that. John and I are actually going to go down to Oregon. Oregon had a big, huge fight, a couple years ago, and they were able to, through the Working Families Party, hire an organizer who went around to small banks and talked with them, and he's very good. I mean, you know how some people can just really, they just know their stuff and they know how to talk with you. They're really charismatic, they can do it. And he worked for an entire year, and he was able to get 4 community bankers to go along with it and say, yes, I will publicly come out in favor of this. So that was after a year of work. So I think that the momentum just has to build, and even with legislators that are kind of residents, you know, to get out there in front, there has to be, you know, enough momentum. That's why actually when John and I started this, we knew it wasn't going to be one legislative session. You know, it often will take, you know, 3, 4, 5 years, you know, for stuff to go. Yeah.
The treasurer was asked last year if this was a turf issue, and he denied it. But I really think it is, because right now his office invests all the money that we don't immediately spend, and they're good at it. But this is a different way of investing the money. This is a way of ensuring that the money that is invested is working in this state. There was a treasurer in Oregon that was starting to come around to the idea of public banking. And we were told by this organizer that Cindy talked about that when this treasurer went to the national meeting of state treasurers, he was told by all the other treasurers that he shouldn't do this. So they're hanging together too. But you're right. I think the banks didn't speak against it last year because they know how unpopular they are. It would have just made it more popular if they spoke against it. Ruth? Well, eventually it would, because the deposit base of the bank are the fees and taxes that now go into Bank of America and then are managed by the state treasurer. The Department of Treasury, or whatever, the Office of the State Treasurer in North Dakota is about 6 people. It's a very small office. They don't need to, I think they might just pay the bills. But the Bank of North Dakota is about 160 people. So it's a lot. There would be a shift of who does the investing in this state.
Oh, for a constitutional amendment. Well, the reason that we have gone to the idea of an infrastructure bank that will loan only to public entities is that there is constitutional provisions in the Washington State Constitution, in several places actually, that says that the credit of Washington State will not be extended to private entities. So right now it's extended in certain ways to private entities, but what was decided by the task force year and a half ago was that we didn't want to fight that because you need 2/3 of the legislature to vote for that constitutional amendment, and then you need just a majority vote by the people. So that's like a long process. We could establish the bank, have that, then you would be in the courts probably for years trying to work it out. Yeah. Yeah. Well, you see, he would still have to go out on the bond market. They would still have to, the entities would, well, right, I believe in order to get the money, he would have to go out on the bond market because a bank, the Office of the State Treasurer does not have banking privileges. The state can only, at this particular time, do revolving fund loans, which means that you can't leverage, right? You can't hold back 10% and leverage. If you have $100, you can't hold back $10 and leverage 90. So that's where the real power of a bank, you know, comes in. You have a very limited capacity, and what we want to do is, you know, make the capacity bigger, and then hopefully, like the Bank of North Dakota, grow over time so that we can you know, the more we have, then the more we can invest in the state. Yeah. Yes. Oh. Oh.
I want to say a little something about the constitutional thing. We live in West Seattle, and we used to have as our state senator Phil Talmadge, who then went to the Supreme Court, and he told me that he doesn't think this is unconstitutional. And then we heard from Lloyd Hara that the main lawyer at the University of Washington, the most senior lawyer in Washington state law, thinks it is unconstitutional, but he has a job as a bond lawyer, so he's got a dog in the fight. So a lot of people have said he's not objective, but the overwhelming opinion of some of the legal staff in Olympia and the representatives and senators is that this would be unconstitutional, and some of our allies think it would be unconstitutional. So we don't want to fight that. There's enough backlog of infrastructure projects that there'll be plenty of places to invest this money.
What was the issue that was unconstitutional?
The state bank, the state bank on the model of North Dakota, and that model is they can loan money to private businesses, but they work through the banking system there, so they're like a banker's bank. So they a local bank will loan to somebody. They know the client. They check out the client, but that bank can go to the Bank of North Dakota to back up their loan, and then they can go back out again. So it's like a banker's bank, and that's all the other. Most of the other states don't have as robust a community banking system as North Dakota. In fact, they have the most robust. And it's because this bank has stood behind those community banks. And whereas in the other states, all the little banks, not all of them, but quite a number of them have been gobbled up by bigger banks. And so that system is frayed. Yeah. Well, we've heard the transaction number. In fact, the treasurer tells us that they're getting a really good deal from Bank of America. I mean, it's like a few cents per transaction, and then normally it's 10 cents or something. So he says this is a really good deal, but then, yeah, it accumulates, but then they aren't in the business of giving good deals. They must get something out of it. Well, I think it's because the money passes through there, and then while it's in there, it's money that they can leverage again on the other side of the equation.
You may also be talking about bonds and how much, debt service we have as far as, bonds that have been floated that we have to go to the big banks. And we don't have that number. I don't know what it is, but I'm sure that we can find out.
It's almost 9%.
Yeah, 9%.
9% of a $32 billion biannual budget, right?
Right.
So
say that into the...
So that's what the issue on the ballot is. They want to take that down to 8%. So the debt service of just Washington State, I don't think that's of all the local governments, is about 9% of the state budget. So 9% of our tax monies goes right back into the banks to pay for the bonds that we floated in the past. And again, that's the state debt. North Dakota has no state debt. So if this bank would eventually get up and running and be, its capital would go back into it, then we could get rid of our debt too. Well, we too were involved somewhat in those kind of campaigns. And of course, when the crash happened, people wanted to pull their money out of local branches of the Wall Street banks, and people went to credit unions or community banks, smaller banks that weren't connected. And for a while, we framed our talk, well, if it's good for us as citizens to take our money out of Wall Street banks, why doesn't the state of Washington take its money out of Wall Street banks? And basically we're still saying that. I just wanted to say something about public banks in other areas. We had a chance in March to go back to a convention that the Public Banking Institute put on. It was a great convention. And I ran into a fellow there who teaches at Kent State, and he said that the banking system in Germany was almost completely public right after Germany unified in the 1870. And the reason for that was they needed capital to industrialize. The German general staff could see that warfare was going industrial, and Germany was behind France and in England. So they needed capital. So what did they do? They put tariff barriers around their country, their new country, and they got the public banks to finance the building of industry. Well, we know Germany became a strong industrial power, and they did exactly the opposite of what the Americans have been telling these countries around the world, which is take down your barriers and let our banks come in and finance you. Well, is it any wonder they're not developing? But I think China's developing. I think they have a bank. Brazil's developing. They have a bank. So again, it's a concept that's proven. Another thing, when we were back in Philadelphia, we saw the Independence Hall and everything. And one of the themes of the conference, of course, is that people like Thomas Jefferson thought the big mistake they made in writing the Constitution was not having control of the money supply and giving that over to the private banks. 20 years after the founding, Jefferson said that's the flaw we made. When you think about it, the emperors always issued the money, or the kings in old Europe, but here we created this democracy, and who has control of the money? The private bankers. And now, after 200 years, we see what happens. So, and thank you all very much.